Well, good morning, and thank you very much. I'm very pleased to be able to address this distinguished audience. I actually want to do two things in this talk, and the first is to introduce to you a new initiative at Sloan and MIT, which is to start a Center for Finance and Policy, which I'm very excited about, and also to talk about a bit of my own research on government and its role in the financial markets, which fits into the research agenda of the center. So to just start with a bit of motivation on why we're starting the Center for Finance and Policy, as Zhang and others have alluded to, certainly the financial crisis showed us the huge import of financial markets for, among other things, the real economy. And in response to that financial crisis, governments got even more involved in financial markets. But I think it's fair to say, and it's certainly quite obvious in the case of China, that governments play a large and important role in allocating financial capital as well as in regulating the private financial markets. Now, I think an area where less has been done than for the private sector is in educating those very policymakers that are responsible for allocating trillions of dollars of financial capital and for making decisions that have far-reaching effects on private financial institutions. So the concept of the Center for Finance and Policy is very simply to start creating education and research really directed at financial decision-making and regulation in the public sector to improve the decision-making that happens there. So basically, the mission of this center will be twofold. The first is research, and that is to create original and timely research that is at the intersection of finance and policy that will help to improve very much the decision-making by policymakers and regulators. The second prong is educational, and that is to begin to give policymakers the kind of education that many of us in this room have shared that gives us the right reflexes, the right basic structure to think about finance, to think about risk and return, but in a public context to make better decisions. Okay, well, I'm in terms of the research, the CFP will have a broad reach, but we're thinking of the main research areas as falling under three major content areas. The first is the one that's closest to my heart, and I like to call it government as a financial institution. As you all know, the government plays a huge role in China, but also in developed so-called capitalist economies, in making loans, making guarantees, providing insurance, managing state assets and pensions. So there's a lot of questions regarding how those functions should work, how they can be improved. The second area of interest of the center is research on the regulation of financial markets and institutions, an analysis of proposed rules and their implications, developing methods to identify emerging risks. Thirdly, there's a strong interest at MIT in understanding better systemic risk. Certainly the crisis showed us the importance of interconnections, the danger of contagion. Professor Andrew Lo has already started a consortium for systemic risk analytics that brings together industry leaders, policymakers, and academics to discuss some of these issues, and that will also be under the CFP's umbrella. Okay, so that sort of gives you a bit of an overview of some of the areas we're hoping to touch with this. And I should say that one thing we're doing is reaching out a lot to alumni and hoping to get you involved. I'm going to turn back to the center later, but what I want to talk to right now is this aspect of government as a financial institution, which I actually think follows quite nicely on the discussion of the previous panel. So I'll be interested also in your feedback. So I would say that academics have actually spent a lot of time studying government as a regulator of financial institutions. So in the US context, we think about how the Federal Reserve or deposit insurance or the SEC affects the function of financial institutions on Wall Street. But relatively little work has been done on the government as a financial institution in its own right. So we have Wall Street, but I think we want Congress and the Capitol right there with it in terms of their influence on the financial markets. So this line of research that I've been pursuing now, I think for over a decade, is focused on this idea that governments are financial institutions and how can we improve them. I'm going to show you some statistics that make the point that probably the US government is the world's largest financial institution, and it has a first-order effect on the distribution of risk and the allocation of capital through those financial activities. When you start thinking of governments as financial institutions, when you seriously think of them that way, the same questions come up. They come up so fundamentally when you're thinking about finance in the private sector. How should the government think about its cost of capital? How it thinks about its cost of capital has a first-order effect on whether it thinks this is a good investment or this is not worthwhile. Related to that, how should it account for its financial activities? How should it measure success or failure? Because the government is so large in the capital markets, it also has to think about its own systemic effects, its macroeconomic impact, what's happening because of its financial activities. And then as a manager of insurance companies, of investment funds, are those institutions well managed? Do managers have the right incentives? And finally, I might add that because governments play such a role in a large role in certain markets, in the US example, in the mortgage market or in the student loan market, there's all kinds of issues of product design. Governments face very little competition. They underprice their competition. So are they creating products that are improving social welfare? Now, these are huge questions, and in the few minutes I have, I can't address all of them, but I'm going to try to talk a little with you to give you a flavor of these questions and possible answers. I'm going to show you some evidence on the US government and its size in the financial markets, and then focus on issues of the cost of capital and accounting for risk in the government, touch very briefly on the macroeconomic activities, and then turn back to the CFP a bit. Okay. So by way of comparison, this graph is showing you the assets of the largest bank holding companies. So I would say the rough statistic is the largest bank holding companies report about $2 trillion in assets. And I'm showing you this because I want to make a comparison to the size of the US government. So I'm going to build this up a bit in pieces. And the first piece, this is a time series, which shows what I would call for the United States their traditional direct and guaranteed loan programs, which topped about $2.3 trillion in 2010. So you can see right away that just the very traditional credit activities of the federal government in the United States are by themselves as large as any one of those financial institutions. Just to sort of give a little bit of depth to this picture, for a very long time, the largest programs in the United States have been directed towards housing through guaranteeing mortgages and also through running most of the student loan programs. And there's other programs for business and agriculture and so forth, but mortgages and education have dominated. The graph sort of goes up towards the latter years because during the financial crisis, the government's role increased over what it had been before. In fact, student loans were the only category of consumer credit in the United States that grew during the financial crisis, and those were all federal student loans. Okay. Well, this graph is actually only a tiny slice of what the US federal government does. The natural next enterprises to bring into the picture are Fannie Mae and Freddie Mac. And I apologize for all the US institutional detail, but they're so large, I think you have probably all heard of them. What they do is they channel money into the mortgage market by purchasing mortgages and securitizing them and providing a credit guarantee. So Fannie Mae and Freddie Mac essentially wind up with the credit risk on over half of the mortgages that are issued in the United States. Now, in terms of their relationship to the federal government, there was a time when they were so-called government-sponsored enterprises, which meant they were owned by private shareholders, but they had what was known as an implicit guarantee by the federal government. And I have them listed in this graph as sort of ghosts going up through the end of 2007. Well, with the financial crisis, they were in imminent danger of failing, and the government did what everyone expected, which was they turned that implicit guarantee into an explicit guarantee, and Fannie Mae and Freddie Mac continue to be guaranteed by the federal government of the United States. So when you add together those traditional credit programs in Fannie and Freddie, you get to a federal involvement in credit markets of over $8 trillion. Well, this graph is not a time series, but rather an accounting for other major credit activities of the US federal government. By far the largest is its backing of the deposits at commercial banks. So that's the Deposit Insurance Corporation there. The next two bars are Fannie and Freddie and the traditional credit programs that I already mentioned to you. Another large set of credit obligations arise through the government's insurance of private defined benefit pension plans. And then there's various and sundry other institutions where the federal government is picking up the credit risk. I have to say that when you add all these things together, you get up to about $18 trillion of total federal liability, and that's a rather narrow measure because it's excluding a lot of insurance functions, Federal Reserve, and so forth, that would make the total even higher. So putting it all together, you can see that the US federal government sort of dwarfs what we usually think of as our large financial institutions, at least by this metric based on assets. So what should we make out of this behemoth financial institution? For me, in understanding how we should think about this $18 trillion, it's useful to go to a bit of a balance sheet approach. So often when we think about the US federal government and its relationship with the public, we think about the Treasury debt, and that's what I have here, which is, I did this all in terms of 2010, which was, the numbers have changed a bit. The Treasury debt is a bit higher. It's about 12 trillion. But in any case, Treasury debt held by the public, sort of the piece we're used to looking at. And so what happens when we put in these loan and guarantee programs? Well, actually, the loans that governments make are assets, and in some sense, they offset the liabilities. And so to the extent that those loans turn out to be worth what was lent out, equity holders, who are the taxpayers, are actually better off for having those loans. Now, the next click makes this graph a little more confusing, but what I'm going to do is I'm going to consolidate onto the balance sheet all the kind of guarantees, the financial guarantees that the government is making. So let's do that. So this is the guaranteed loans, Fannie and Freddie, all those other liabilities I showed you on the previous slides. So you can think of any kind of a credit guarantee as being effectively as if the government owns the asset, if they own the mortgages made by Fannie and Freddie, say, and if they finance them themselves. So they take on the debt of Fannie and Freddie, They back the MBS and so forth. So sort of from a consolidated point of view, these obligations create both assets and liabilities. But where the rub actually is when you think about the risk. So if everything goes well, then there's a lot of offset. The assets and liabilities are offsetting, but really what governments do when they take big positions in credit markets is they become very exposed to the tail risk of those obligations. So as I said before, there's a lot of private debt, a lot of private equity that is in many cases in a first loss position, but the government has absorbed a great deal of the tail risk in the credit markets. Okay. So a big question, and one that I really want to emphasize, I think governments, developed market governments have not addressed adequately, is how to measure particularly the costs, but also the benefits of these different interventions. So that's sort of the main focus of what I'm going to talk about for a few minutes. So just sort of broadly speaking, economic theory has talked quite a bit about the potential benefits of government involvement in credit markets, and it takes two main arguments. First, governments may be more capable than private enterprises at spreading risk. The government is big, the government can force risk sharing, and so it may be that governments are actually the efficient place to spread catastrophic risk. The other way that governments can create superior social outcomes over private markets is to address what economists have referred to as credit rationing. Now, credit rationing arises because of incomplete information in private markets. I think student loans are one of the best examples. So you're a student, you come from a modest family, no one knows whether you're ever going to pay back your loans or not, and you go to a bank, and the bank says, well, I'm sorry, I would like to make you a loan, but I can't because it's really too risky. So rather than figuring out whether you're good or bad, that's too expensive, so I won't make you a loan at all. So a rationale for the government to step in is that they can take risks that the private sector won't to overcome this kind of credit rationing. Of course, they don't know any more than the banks do about whether you're good or bad, but one thing the governments can do is they can take the risks, incur some losses, and that may, from a welfare-enhancing sense, make things better off. Okay, so there are potential benefits, but certainly when the governments get involved in credit markets, there's also costs. There's the obvious direct costs that the government will bear those losses, and those losses will ultimately be transferred to taxpayers. There's also a lot of significant but harder to measure indirect costs, potentially misallocation of capital, crowding out of private capital. Governments often provide guarantees that increase the incentives for risk-taking. And then finally, oftentimes the kind of subsidies that are created by government credit programs are not transparent, and that creates an incentive for policymakers to rely more on them because they can do them under the table. So in my own interest for many years has actually focused on proper cost measurement of these government commitments. I actually believe it's as important to measure the benefits as the costs. I think the costs are very important because that's what we say the costs are, enter the political calculus of is this worthwhile, is it not? Also, it's easier to take a cut at the cost than the benefits, but I really don't want to neglect the benefits, but I do want to focus on the cost. So I like to offer this quote from Peter Fisher, who some of you may know. He was an Undersecretary of Treasury for Domestic Finance for a few years, and for a longer time, he's been at BlackRock as a managing director of fixed income. Well, while he was at Treasury, he had some experiences that very much resonate with me. So let me just read you the quote. He said, "I found myself awkwardly defending the federal fisc from both on and off balance sheet attacks. With each new topic I confronted, I tried to engage my counterparts in the language of finance, risk and exposure, but found myself treated as if I were speaking a foreign language completely unrecognizable to the indigenous population. So he said, well, I had to get out of Washington, so I would go and give speeches, and I would give speeches where I compared the federal government to a gigantic insurance company with a sideline business in national defense and homeland security, which does its accounting on a cash basis, only counting premiums and payouts as they go in and out the door. For good measure, I noted, an insurance company with cash accounting is not really an insurance company at all. It is an accident waiting to happen. Okay, so I think this very nicely sums up the state of most public budgeting for credit, which is there's a very large proclivity to account for things on a cash basis, which really can't be understood that way. So let me elaborate on these issues. So in the US context, but I've been doing a lot of work on the international case now, and so I'm going to say what I have to say is very universal. So in terms of the programs I described to you, some are accounted for on a cash basis, which is just tracking money going in and out. Other programs are accounted for on what I'm calling a naive accrual basis, which means that you evaluate the cost of credit on a present value basis, but you use treasury rates for discounting. And then the third, a few programs are accounted for at what I would call fair value, and that's what I'm going to endorse as the most transparent way of understanding what's going on with these government programs. So to elaborate a bit, and this, if you don't take anything else away from my talk today, I think this is the most important point, which is that most governments around the world, including in the US, use their borrowing rate as their cost of capital when they're accounting for both government enterprises like government power companies, government utilities, but also government investments in financial markets. The result of treating low borrowing rates as a capital cost is that almost everything looks like a worthwhile investment. And so this creates a large presumption that these government investments are the right thing to do, that they're worthwhile. An alternative, which is actually quite live in the US political process in terms of a discussion of whether we should move there, is to have the government, like the private sector, account for their activities on a fair value basis, which captures something like a market value of those activities. Probably a number of you are thinking, well, the government's cost of capital is its cost of borrowing, right? I mean, when the government goes out into the capital markets, it can borrow at low rates. So why, in fact, isn't that the cost of capital? So actually, what I'm going to go through now was ideas that were also born at MIT. And this time I'll say it's Modigliani and Modigliani-Miller theorem, but that theorem applies to the government as well as to the private sector. But let's see how it works out in the government case. So again, let me stick with student loans, which I like to use as an example. So the government makes student loans, say 100 million of them, and they charge the students 3%, same as the treasury rate. Okay, so on the government balance sheet, you have an asset, you have a liability, and if everything goes well with those loans, next year the students will pay them back. They'll have 103 million in cash that will cover the treasury debt, which notionally was issued to fund them. Well, of course, if the economy isn't going well, maybe the students won't be able to pay back all of those loans, and they'll only pay back partially. In that case, say $73 million comes back. the Treasury is still going to honor its debt commitment of the $103 million to the Treasury debt holders. And so what's missing from that initial characterization is that somewhere in any transaction, in any risky transaction, there has to be an equity holder. It always has to be true that the weighted average returns, the losses have to be borne by someone. So in the place of an equity holder in a private company, what you have in the government are the taxpayers that are ultimately standing there absorbing the risks. And of course, they're also absorbing gains. So they're like equity holders with unlimited liabilities taking on gains and losses. Well, viewed from this perspective, the logic that's so fundamental to what you learn in your first corporate finance class, that the cost of capital for a particular enterprise depends on the risk of that enterprise, not on how it's financed, also applies to the government. The only reason that governments can borrow at such extraordinarily low rates is because they essentially have put options that are financed by the taxpayers that make that debt safe. So looking at the cost of the debt can't be a full accounting of the cost of the obligations. Fair value accounting for government obligations addresses that issue by looking at the weighted average cost of capital in the same way a private company would and assigning a charge for risk. Now, I know that in the business community there's a love-hate relationship with fair value, and sometimes there's restrictions on having to use it that are inconvenient. But I also want to put in a good word for the possibility of using fair value accounting, even though you're probably thinking, well, where is the government ever going to figure out what the prices are on things where only the government does it? And I would say this is another place where sort of modern finance theory is very helpful, because basically what you need to do is take what the government is doing and project it onto the closest activity where you can sort of infer a cost of capital. So the easiest case is maybe something like mortgages, where you can look at private mortgage markets and you can see what kind of risk premiums are being applied in the private sector. Or in the case of student loans, there may be some private student loans, but at least there's unsecured consumer credit, and you can get an idea of what the risk premium would be. But right now, essentially, there's a zero risk premium being assigned to these obligations, and that's where the problem lies. So let me give you a concrete example from the case of Fannie Mae and Freddie Mac. So I told you before that the government had taken them over as a result of the financial crisis, and now there's quite a behind the scenes but intense discussion of what to do, because the United States mortgage market remains, I think, over 90% underwritten by the federal government. Most of the credit risk of the market is still going to Fannie Mae, Freddie Mac, or some other kind of federal guarantor. So the numbers I have here are numbers that some of my former colleagues at the Congressional Budget Office put together, which are projections of the cost to the government of Fannie Mae and Freddie Mac going forward over the next decade. And it's comparing those costs on different accounting bases. So when you look at and one more thing I have to say about these numbers is if there's a negative sign in front of a number, like the -6, which is the first number in the table for 2011, that means that the government would make $6 billion on the new business created in 2011. Okay, so under what I have as FICRA accounting, that's what I described to you as naive accrual accounting. When you look at Fannie and Freddie going forward and you use treasury rates for discounting losses, it looks like keeping Fannie Mae and Freddie Mac in the federal government is going to be profitable for the federal government as far as the eye can see. And that should come as no surprise, because in fact, if you discount the risk associated with almost any financial activity, that is the risk premium associated with that activity, it's going to look a lot more profitable. Also looking at them on a cash basis, which is the bottom line there, they were expecting that there would still be some residual losses from the financial crisis through 2012, but then after that on a cash basis also, because again, that doesn't adjust for a risk premium, they look profitable going forward. The only place where Fannie and Freddie look like they actually cost the government something in terms of risk bearing is when you do the analysis on a fair value basis. Now, why does this matter in the world? I think it matters a lot because in the government sector, these budgetary numbers, whether they're right or wrong, they are the price system for governments. And when governments are allocating resources, they take these numbers seriously. They don't say, how did you create this number? Is it right or wrong? They just take the number that they're given. So in this discussion on privatization, the conversation will look quite different if it looks like Fannie and Freddie are reducing the budget deficit rather than increasing it. So getting the numbers right can have important real effects. Let me, okay. So that's sort of that's an example of some of the work that I've been involved in and continue to do, which is directed at looking at government financial obligations and looking to develop methodologies that improve the way cost is measured, that get you to fair value estimates. And I have to say it can be quite tricky because, as I mentioned, the government often crowds out the private sector, so figuring out what the right basis is for valuation, whether to use options pricing methods, how to risk adjust discount rates, it can be a little bit tricky. So it's very important to improve how these things are accounted for and to make officials aware of what the best method is for reporting them. However, I will say that the costs of these interventions are quite small relative to the size of the guaranteed obligations. So I threw out a number earlier which said that the federal government had something like $18 trillion of credit exposure. But in fact, well, and let me back up from that. I also said that the traditional credit programs were about 2.3 trillion of credit exposure. Now this bullet that I have up here now about the subsidy cost, the way the US government now estimates the subsidies associated with its traditional credit programs, they estimate that they make about $45 billion a year on those credit programs. So they write down that they reduce the budget deficit by about $45 billion on what are actually highly subsidized credit programs. Were you to fix that accounting, it would look like it would increase the deficit by about $11 billion. So we're talking about a $56 billion misreporting of, if you will, of the subsidy cost of that credit. $56 billion, it's an important number, but it's not huge. So for all the effort and all the years I've been thinking about government credit programs, I actually wanted to broaden the analysis, and this is where I want to go now, which is to talk a little bit about the broader impact of these credit programs. Okay, so I just want to make it clear that what I mean by the subsidy cost, that's essentially the NPV of the expected losses from those loans and guarantees. So it's a risk-adjusted total of those losses. But how about the broader impact? So recently, my research expanded to think a little bit about the macroeconomic impact of these programs, and I want to just describe that to you very briefly. So in summary of what I've found is that the impact of these federal credit programs on the macroeconomy is much, much larger than the subsidy cost, but certainly much smaller than the total volume of federally backed credit. Okay. So in terms of the effect, conceptually, what I'm interested in is the volume of incremental expenditures in the economy that result from these credit programs. Okay. Well, these effects are particularly important during periods of financial crisis. And let me tell you exactly the analysis that I did, very briefly. And yes, I couldn't resist also putting an equation up here for you to look at. So if you think about the federal government starting a credit program or running a credit program, and you want to think about what are its effects on the macroeconomy, you can decompose that into several pieces. So the DB there is the change in the aggregate supply of credit as a result of government programs. The first piece is just the change in the availability of credit. This gets back to the idea of credit rationing, or particularly during the financial crisis, banks became very unwilling to offer credit. There was a lot of risk, liquidity problems, so the government made credit more available. That was the DA. The government also affects the amount of borrowing out there through the subsidies. That's an elasticity effect. If the government subsidizes credit, people are going to demand more of it. That's that second term with the SDBDS. And then finally, when the government takes a larger position in credit markets, there's only so much savings, so it crowds out some private provision of borrowing, and that's the minus C, the crowding out term. Okay, so looking at in summary and skipping a lot of detail of calculations, in 2010, the programs that I told you about earlier, I estimated increased borrowing in the US by about $559 billion. Now that's a big number. In terms of thinking about its stimulus effects on the macroeconomy, one important correction is to subtract out new borrowing, which just went to pay back old borrowing. There was a lot of refinancing of mortgages. So with that adjustment, I estimate that the effect of government credit programs in 2010 on incremental borrowing that went into the real economy was about $342 billion. And there's admittedly many assumptions that go into this, but I think sort of as an order of magnitude, it's interesting. To give it some context, the government's largest fiscal stimulus program injected about $392 billion into the US economy. So just the sort of passive functioning of the government's credit activities was on the same order of magnitude as its traditional fiscal programs. So this is interesting from a variety of perspectives. One is that the traditional fiscal stimulus gets a lot of attention in the media. People focus on it. I think these credit programs get much less attention. And so it's sort of interesting to see how important they are. I think it's important to add that in a normal year, I don't believe that the incremental effect of those credit programs is nearly as big because there's more crowding out of private lending and there's not as much demand for the government programs. Okay. Well, in any case, I hope that this has served as an example of some of the issues that arise at the intersection of finance and policy and the need for there to be more research, more education on finance and policy. So as I started out by saying, we're hoping that the CFP will begin to fill some of those gaps. And even before I jump to the next slide, I want to say I love the Chinese tradition of thanking your mentors for, that's just wonderful. And certainly on the CFP, I don't know if he's still here, but Dean Schmidtlein has been an amazing supporter of this initiative, as has the finance group, Professor Wang, MIT administration more generally, a lot of alumni from around the world. So I would have a lot of people to thank, and I'm running out of time, so let me not do that, but many thanks. So, you know, as people have alluded to, MIT has been a place for financial innovation for over 40 years. Some of the people, the famous people on this slide, we're lucky to have them here today. We'd like to think that this initiative on finance and policy might be one of the things that help the name of MIT continue to be associated with innovation over the next 40 years. We think MIT is the right place for the center. The finance group has many people who are quite interested in this nexus between policy and finance. There's a lot of leadership among the faculty. Beyond that, this is an MIT-wide initiative. It's the kind of problems that come up need input, not just from finance professors, but from economics, from big data, political science, EE, and so forth. So it's a school-wide initiative. We also will be able to draw on our very strong relationships both with the business community and with the regulatory community in the United States. It's an interdisciplinary approach, as I just said, and I also want to emphasize that our interests are international, not just the US. I think many of the things that we're going to do are as relevant in Shanghai as they are in Boston. So interesting. We're in the process now of moving the center forward, still at the beginning phases, but we're putting together an advisory board of faculty and industry leaders and public sector leaders that will give us advice and guide our activities. We're planning to have a group of fellows who will operate in many capacities, among them contributing research, but also serving as ambassadors to their various communities. I'm directing the center. Andrei Kirilenko, who is the chief economist at CFTC, has come on board and is working hard on the regulatory aspects. Professor Andrew Lowe is heading off the efforts on systemic risk. Professor Robert Merton is just an all-around participant in all our activities. So we're optimistic that way. As I said, we're just getting started. We have had a number of preliminary activities. We're planning to have a big inaugural conference this fall, and a lot of research projects are already getting underway with students. So with that as an overview, I thank you for your attention, and let me open it up for any questions you might have. Thank you.
Thank you, Professor Lucas. I think we have time for one or two questions. Right over there.
Hi, Professor Lucas. This is Jim Ye from Shanghai Financial, safe. That's where Dr. Wang is. Got a question because of the Chinese government currently is holding more than 1.3 trillion U.S. government bonds. So there have been quite a bit of talk regarding the fiscal policy of the United States. I'd like to ask you from drawing upon your CBO experience to see if this kind of worry is overblown or is a valid concern for the Chinese government. Thanks.
Well, if I were working for the Chinese government, I would be, and I were managing such a large pool of money and an important public trust, I would be concerned about diversification. I don't think that I really don't believe the US government is going to default on their treasury obligations. And I know that every once in a while we have political theater where Congress says, well, maybe we won't pay those bills. But I don't think that's going to happen. But quite honestly, there is exchange rate risk in holding a large share of investments in any currency. And, maybe Steve Ross can tell you, but I can't, what will happen to the dollar in the future. And I think one of the things that people are interested in the CFP is thinking hard about the issues of how sovereigns invest their wealth and what the right objectives is. So I think that's one of the areas we'd like to be involved in.
And we have one final question to the right of the room. Thank you.
Hi, good afternoon. And we are so happy to see MIT is taking the lead to create such a center for finance and policy. But my question is that how can Sloan School really do more in education, you see, to help the world to prevent like future financial crisis or bubbles? Because we know MIT each year produces like 1,000 excellent engineers. But from the statistics, we can see like if finance people only like you see a bunch of them, a handful of them. But a financial crisis and bubbles are so detrimental and constructive to the world, to the people's well-being. So we really hope MIT, you see, should do more of that, particularly like a Sloan School. But I think it's taking the lead. We are happy to see that, and we would like to, you see, so your comments, like, you see, do you have future plans, like 5, 10 years? Thank you.
Okay, well, yeah, I'm very sympathetic to the question of the importance of financial education and getting good financial education, excellent financial education out to a much broader group than the privileged few who are able to get it directly. But I think, I actually think Sloan is doing some very good things on that front. Our expansion into having a Master's of Finance program is really a big step, because rather than just producing a small number of MBAs every year whose concentration is mainly finance, we're now producing over 100 students each year with a Master's of Finance degree who have gotten the kind of fundamental education, who are developing the resources and the thought patterns that hopefully will help prevent the kind of crises that we've seen. But even that army of 100 people going out is maybe a drop in the bucket of the world's needs in terms of financial education. So something else that I'm personally very enthusiastic about that's happening at Sloan and MIT more broadly is thinking hard about how we can move towards online education through edX, which is the joint MIT, Harvard, other schools efforts to create materials that will be available online for free or at a very low cost to try to engage more people in understanding. Whether it will stop the next crisis, I don't know, but we can hope that it will reduce the probability.
I think that's it for questions. Thank you.
Thank you.